Hello, everyone, and welcome to another episode of Accounting After Dark, where I go through questions that I don't own the rights to. Okay, so here we've got a good, nice, comprehensive problem. So let's take a look at this one here. So Amigos Burrito sells franchises to independent operators throughout the northwestern part of the United States. Their contract with the franchisee includes the following provisions. So let's kind of talk about this really quickly. So a franchisor, they own the rights. And what they're going to do is they're going to sell the franchise to the franchisee. Okay, and then what the franchisee is going to do is going to be remitting back to the franchisor. Generally, it's going to be cash. Okay, and so basically that's pretty much what it is. And they own the rights. Okay, so typical franchising operations, right? Subway, Doctors Associates. They're the franchisor. They go to individuals who want to own Subway shops. Another one is, I believe another one would be something like Quiznos. In-N-Out is not a franchise. Very, very important. Dunkin' Donuts is a franchise. And some stores go from different things in terms of everything's a franchise, nothing's a franchise. And the reason being is because once you have a franchisee, you have to keep tight monitor over them because you want to make sure that they're not destroying your brand. But that's generally how this works. And so the franchisor is generally going to charge a franchising fee for the right to franchise their operations. Depends on how strong of the brand name is. If In-N-Out were to ever franchise their stores, they would be charging an obnoxious amount of fees. And it would be simply for the reason is because that brand name is so strong that you're going to have people going in and out of there all the time. No pun intended. So, but the other way that the franchisors make money, for example, like Subway, they're going to tell all their franchisees, you got to buy the bread, you got to buy the lettuce, you got to buy the tomatoes, the mushrooms, everything from us. Why do they do that? It's a way for them to, one, control the quality of the ingredients that they put in. And it's also another way for them to make money is by selling them the different stuff. So let's take a look at this agreement. So the franchisee is charged an initial fee of $120,000. Of this amount, $20,000 is payable when the agreement is signed, and a $100,000 zero interest-bearing note is payable with a $20,000 payment in the end of each of the 5 subsequent years. The present value of an ordinary annuity of the 5 annual receipts of $20,000, each discounted at 10%, is $75,816. How nice of them for us to do that for us. And in a moment, I'll show you how we could actually go through and compute that. So of all the initial franchise fee collected by Amigos is to be refunded. All of the initial franchise fee collected by Amigos is to be refunded, and the remaining obligation canceled if for any reason the franchisee fails to open his or her franchise. Okay, that's very important. In the event, right, so if they're getting that initial fee and the $20,000 is payable, that generally shouldn't be recognized until they actually get basically until it's opened up. So in return for the initial franchise fee, Amigos agrees to assist the franchisee in selecting the location for the business. That's very important. Negotiate the lease for the land, also important. Obtain financing and assist with the building design. Supervise construction, establish accounting and tax records, and provide expert advice over a 5-year period relating to such matters as employee and management training, quality control, and promotion. The continuing involvement by Amigos helps maintain the brand value of the franchise. So in addition to the initial franchise fee, the franchise is required to pay Amigos a monthly fee of 2% of sales for menu planning, recipe innovations, and the privilege of purchasing ingredients from Amigos at or below prevailing market prices. So management of Amigos Burrito estimates the value of the services rendered to the franchisee at the time the contract is signed is to be at least $20,000. All franchisees to date have opened their locations at the scheduled time. None have defaulted on any of the notes receivable. The credit ratings of all franchisees would entitle them to borrow the current interest rate of 10%. So discuss the alternatives that Amigos Burritos might use to account for the franchise fees. Prepare journal entries for the initial and continuing franchise fees, assuming franchise agreement is signed on January 5th. Amigos completes the franchise startup tasks and the franchise opens on July 1st. The franchise records $260,000 in sales in the first 6 months of operations and remits the monthly franchise fee on December 31st. Briefly describe the accounting for unearned franchise fees, assuming that Amigos has little or no involvement with the franchise related to expert advice on employee and management training, quality control, promotion once the franchise opens. Okay, so when we see this here is discuss the alternatives that they might use to account for the franchise fees. So really the key is going to be the store opening, okay? And this is why all of the initial franchisee collected by Amigos is to be refunded and the remaining obligation canceled if for any reason the franchisee fails to open his or her franchise. So when we look at this, right, I can't, even if I get the cash on January 5th with the money, I'm not going to be able to recognize that particular revenue, at least initially, until the store is actually opened. So we know that we have to at least wait until that store is open to start recognizing revenues. So right up here is in return for the initial franchise fee, Amigos agrees to assist in the franchise to select the location of the business. Okay, so if we're looking at this here, so part A is a pre-opening cost. Part B is going to be pre-opening. Part C are obtaining financing and assist with building design. This is pre-opening. D is supervising construction. Okay, this is all pre-opening. Okay, now establishing, it's not maintaining, but E is pre-opening. Now here is going to be the only subsequent advice, or basically over here is going to be provide expert advice over a 5-year period relating to such matters as employee and management training, quality control, and promotion. Okay, so this continuing involvement by Amigos helps maintain the brand value of the franchise. So we'll say over here, expert advice. Okay, so we know this, and then when we look at over here, and this is really the franchise fees. Okay, and then the other parts here, like number 4, this is really kind of what relates to basically ongoing fees. So the alternatives that they have here is that, one, this is really what's key. How significant is this? If this is significant, meaning that they're going to be really involved, right, from day one for the next 5 years, then you might say that, well, you could maybe recognize about 20 grand up front, because essentially once they open the store, it's non-refundable. And then it's really $20,000 per year, essentially for the next 5 years. So that's basically how you would kind of go through and look at it. The other thing too is that $20,000 a year is essentially, how would I put it? Obviously, it's something, it just kind of depends on how, again, that expert advice. So if the expert advice is significant, probably would be recognizing the revenue over a 5-year period. If it is immaterial or if it's not really considered to be a huge deal, then you could probably justify having the franchise recognizing that revenue upfront. The other thing that kind of also gives us some additional information here is if you look at this right here, as it says that all franchisees to date have opened their locations at the scheduled time, and none have defaulted on any of the notes receivable. So if this is in fact the case, then that also goes to saying, well, we could be opening this up almost immediately. So when you're looking at the different alternatives, and I just want to kind of see, just give me a moment. I just kind of want to see if your textbook really has anything to add here in terms of that. Just I'll pause real quick. So one of the other points that's made by the textbook is it says basically in the case of a franchisee, fees related to rights to use intellectual property, which is really at the franchisor or franchisee. If you kind of think about it, like if I'm selling hamburgers, am I going to sell them a lot as Bennett's Big Burgers or like sell more as In-N-Out? Is that usually basically the rights to use the intellectual property generally are recognized at a point in time, usually when the franchise begins operation. That is because at that time, the customer controls the product or service in which it has the ability to direct the use and obtain substantially all the remaining benefits from the franchise rights. Control also includes the customer's abilities to prevent other companies from directing the use of or receiving the benefit of the asset or service. So the continuing franchise fees, which are really kind of the sales of the different products, that's going to be more recognized over a period of time. So let's go over here then. So that's kind of the different ways we could account for it. So when the franchise agreement is signed on January 5th of 2020, what exactly is happening? We're going to be receiving cash of $20,000, okay? And we're also going to have a note receivable of $100,000, okay? And in terms of this note receivable, okay, we're also going to have a discount on notes receivable. And the amount of the discount is going to be, let's also just do this too. So we have discount on notes receivable. Then we're going to have unearned franchise fees. Okay. So the amount of the discount is going to be 100,000 minus 25,000 minus 75,816, which is the present value of those future payments, or 24,184. So the unearned franchise fees is going to be the difference to basically balance my equation. So here is 95,816. So one of the things I shared with you is that I would be showing you from a present value standpoint is how do they come up with this 75,816? So there's a couple different ways they could do it. So we got year 1, year 2, year 3, year 4, year 5. The amount of the payment that they're receiving every single year is 20,000. And I have to bring this back here to today or at year 0. Now, one way I could do this is I could go over to the present value of a dollar. So if I go to the present value table of a dollar, okay, let's pull this up. And perfect. Oh, this is nice. Okay. So the numbers I want, okay, so I'm going to bring back these each individually. So the first one is going to be 0.9091. My next one is going to be 0.8265. Okay, my next one is going to be 0.7513. My next one is going to be 0.6830. And then my next one is going to be 0.6209. When I multiply each of these, I'm bringing them back to today's dollars. What this means is at one period at 10%, to bring this back, I multiply it by 0.9091. And then I'm going to be going through and combining these up. So when I go through and I combine these up, the total value we should get is this 75,816, or somewhere close to that. There we go. So that's where the book is getting this number from. Now, there's another easier way I could have done this. This is all from over here. This is present value of a dollar table, which is used for single payments. So, but because these payments are all the same, this is also known as what is called an annuity. And in order to make this a little bit easier on myself, if I get a question like this, what I can do is I can take the annuity amount, and my annuity amount is 20,000. What I can then do is I can go to a different table. It's called a present value of an ordinary annuity of $1. I'm going to say 5 periods, or the number of times that interest is being computed at 10%. So if I change this over here, let's see here. Let's go back over here. It's the present value table of an ordinary annuity of $1. Let's look at some images. Okay, oh, Chegg. Awesome. Yeah, there we go. And I know exactly where this thing came from. Good stuff. All right. Of course, it's covered up for me. So Chegg, wow. Chegg. Okay, I love this one. This is Intermediate Accounting to Fashionably. Whoever made this is like sweet. Okay, these are all future values. This is the one I want. So when I go over here to the number of times that the payments are being made, which is 5 at 10%. And here you're getting at 0.379079. So 3.79079. If I multiply the 20,000 by this value here, oh, I get the same number, okay? And the reason why is I can use this present value of an annuity of $1 table if the payments are the same. If I went through this way too quickly, okay, what I want you to do is I want you to go back to Canvas, and I want you to take a look at the Intermediate Accounting 2 charts, where I go through and go talk about bonds, because that is exactly where this came from. Okay, so when I go through and I show this here, I cannot, because the amount that's due in the future is this note receivable, 75,816. So I can't recognize $100,000 worth of revenue. I can't go 120, 120. There's an implicit amount of interest in this. And so therefore I have to go through and basically recognize this discount. So this right over here is just going to be to record basically record initial franchise agreement. Okay, so this is the journal entry on January 5th, all that work just for that. So Amigos completes the franchise startup tasks, and the franchise opens on July 1st. So on July 1st, what we can go through and do is we can basically state, like right over here, we can basically say, okay, we know that we can basically go ahead and recognize this $20,000 as a franchise fee. And the reason is because once we open up the store, this becomes non-refundable. So over here, so I'm going to debit unearned franchise fee, and then I'm going to credit franchise revenue. Okay. Okay. So the also too, management of Amigos Burritos estimates the value of services to be rendered to the franchise. The time the contract is signed amounts to at least 20,000. So we've done that now that the store has gone ahead and opened up. Okay. So what now happens? So this is basically on July 1st. And now we get over here to December 31st. So the next part over here now, could I go through and recognize everything else? Could I recognize the other 75,000? I would probably say it wouldn't be a good idea, just because what is happening here is that they have to kind of continue going through, and they're basically continuing to go through and to perform services. So that's probably why this is better left not recognizing anything else. Let's go over here to December 31st, 2020. Okay. So when I look at this over here, the amount of the franchise revenue that I'm going to be going through and recording. So let's take a look at our unearned franchise fees. So my unearned revenue, or my unearned franchise fees, is a total over here of $95,816, and this is what I recorded on January 5th. I then had over here on July 1st, I had basically a debit to this account. So the remaining amount is going to be here a total of $75,816. Now, as I'm going to be, this is basically essentially over a 5-year period. So what I'm going to go through and do is I want to go ahead and recognize this franchise fee over 5 years. So the way that the book has it, and I don't disagree with them on this, but right over here, so every year. So my total franchise fee is $75,816. The months, basically the 5-year period, which is going to be 60 months. So the amount that I recognize for my franchise fee per month is $1,264. Okay. So when I get this $1,264 from July 1st, 2020 through December 31st, 2020, this is going to be $1,264 per month times basically, this is going to be 6 months. So the amount of revenue that I'm going to be recognizing is going to be $7,582. So here, my unearned franchise fee is going to be $7,582. And then basically over here, I've got franchise revenues of $7,582. So I want to recognize this because this is what is actually happening on, I've actually had over here, basically that amount basically in terms of services. So right over here to record franchise revenue, or basically what they're calling is record ongoing fees for brand maintenance. Okay. So the next thing I also have to do too is I'm receiving money. So basically over here, I'm receiving cash of $20,000, and this is going to be on December 31st, 2020. Okay, so let's go through and have some fun with this. So the carrying value of my note receivable. So over here, my note receivable is at 100 less the discount. My discount amount was $24,184. My notes receivable net was $75,816. My interest rate is going to be at 10%. And so over here, my amount of interest revenue is going to be 7,582. So basically what I'm going to do, or I shouldn't call this is going to be interest revenue, or basically how I'm amortizing. This is also the way I'm going to be amortizing the note. So over here, I'm going to have a debit to discount on notes receivable of 7582. I'm going to have a credit over here to interest revenue of 7582. And then I'm crediting notes receivable for this amount right here. So this should look somewhat familiar because this is what we've been doing with the other questions. It's just the other ones were zero interest bearing. This is now actually involving a note. Okay, so we're going to have some fun here. And then, so this is the, let's see here. Journal entries on January 5th, and then remits the monthly franchise fee on December 31st. So the other thing we're going to do too is there's one other part, and which is basically this last part, which is going to be 12/31/20. And let me just do this real quick. The other thing I have to do is I need to show the amount of the percentage that I'm collecting because of the sales. So here they recorded $260,000 in sales. So the amount that I collect on that, it's going to be 2% of that amount. So if my sales were 260,000, 2% of that amount, so what we would do here is I'd be debiting cash for 5,200, and I would then be crediting franchise revenue. And this is basically to record franchise fee on the on sales. Okay, more than likely there was probably some other stuff happening in terms of the buying of the ingredients, but we didn't really get into that in this question. The other thing I want to do with you, because this is intermediate accounting, by the way, is let's take a look at this really clearly, and let's take a look to see what happens here in the future. So this here was 2020. Okay, so in 2021, what's going to happen? Okay, so in 2021, we're going to have the same issue over here, right? So we're recognizing the unearned franchise fee more or less on a straight line basis. So here, my unearned franchise fees is basically going to be this is going to be 1,264, but in this case, this is going to be over a 12-month period. Okay. And as we go through and we do this, we can kind of see that over time, so this would be 2021, (2022) would be the same if we're doing it straight line. 2023 would be the same if we're doing it straight line. 2024 would be the same if we're doing it straight line. I also forgot to throw in here 2020. So in 2020, we had 7582. And then in 2025, basically you've got another 6 months or 7582. If I go through here and I'm adding up these columns, basically these 5 here, this is essentially going to be ultimately going down to 0. Okay. So that's how that would go through and work, right? Ultimately, if the store keeps operating, that's what's going to happen. But what happens with this note receivable? Okay, so this note receivable right now, as of 2020, right? This is where we started here. This is our first year. We had this initial discount. And what happens though in 2021? Well, in 2021, right, they paid off 80,000 or 20,000 of this note, right? Because they're making this installment payment every single year. So now my note receivable amount is going to be 80,000. That's what the amount that's owed. My discount is no longer 24,184 because I went through and I amortized it here by 7582. So over here, my new discount is going to be this. So my notes receivable net for 2021 is going to be 63,398. So when I multiply this through here, this is going to be 6,340. That's in 2021. What happens in 2022? Well, they're going to pay another 20,000 on the note, right? So 2021, it's pretty much going to be the same journal entry again. So 12/31/21. It's going to be cash, discounted notes payable is now going to be 6340, record collection of the note. So again, for 2022, taking this off by another 20,000 here. I'm also amortizing this here. And then I'm getting my interest rate coming down here to 4,974. 2023, again, just paid another 20 grand on the note. This is also now being amortized at 0.1. So this is now 20,000 to 1818, 118, 182. And when this note is finally paid off, what you're going to see here is that this now has been fully amortized. So the discount would basically bring this down to 0 on the very last year of this. So thank you for watching this here today. Hopefully you'll have some questions on this. This is one of the tougher questions. I think we had one last part here to answer. So briefly describe the accounting for the unearned franchise fee, assuming that Amigos has little or no involvement with the franchisee related to expert advice on employee and management training, quality control, promotion once the franchise opens. If that is the case, then you could recognize this entire amount of $95,816 when the franchise opens. The reason why we didn't do that is there's some language in here is that the over a 5-year period relating to such matters, and then basically the continuing involvement by Amigos helps maintain the brand value of the franchise. So this is the real reason why we're not going through and recognizing all of this at once. So I hope you enjoyed this conversation here today. It's always fun. And this is more for me than for you. I will see you in class soon and have a great one.